The European Central Bank has recently left interest rates on hold, but indicated in its strongest hint yet that monetary support will be given for the Eurozone. It'll be stepped up in the autumn, according to the latest statement. The next meeting is on the 12th of September, and Mario Draghi's last meeting on the 24th of October. Where will rates be when Christine Lagarde takes over? Her first meeting is in December. Add to this the now 75% chance that markets are currently pricing in for the Fed to move on Wednesday the 31st of July. Sean Corrigan joins us now from Cantillon Consulting. Sean, welcome. I'm mindful of comments as well from Philip Lowe, the Reserve Bank of Australia governor, recently saying it's really just a race to the bottom. If everybody cuts interest rates, there's no advantage in doing so.
Well, we do seem to be in that situation, don't we? And this was something that was warned about 5 years or more ago by a very senior figure in international finance who said that exactly this thing of the one bank following the other and trying to bring the advantage back puts us in a spiral which is ultimately counterproductive. I mean, we've even had Mr. Haldane at the Bank of England, who's been one of the most fervent of the bulls and the let's get everybody spending and borrowing in his role as economist. He's now saying we now have a generation which has never seen an interest rate hike, has only ever seen, we now have a culture of dependency. I mean, well, yes, but who did this, sir? It was you and your guys who thought you were going to lead us out of troubles and have now put yourself in a cul-de-sac.
So what are the answers then? I mean, we just had, as I said, the European Central Bank saying the only thing now is for further easing. In other words, they're going back on their policy of stopping QE at the back end of last year, and they're now talking about potentially dropping repo down to, or deposit rates down to half of 1%, a negative half of 1%.
Which will have a knock on everywhere. The Swiss will probably have to follow, the Swedes, the Danes, and so on and so forth. And so the madness spreads. Yes, I know. Well, again, if we pick up Mr. Haldane, who seems to have had a bit of a road to Damascus moment, he pulled out the obvious point that what we actually need is we need structural changes, political changes to make creating wealth and creating jobs and improving people's prosperity. We don't just need to be relying on this one-trick pony that we've been riding now for a decade, and so this is exactly the case.
Keynesian policy of spending, government spending. I mean, this is, I guess, what Boris Johnson now really wants to do. It looks like he's going to have to spend a lot of money in doing what he's committed to now.
Well, that's the worry, that we flip from one side of the boat to the other, and I don't think that would be helpful either. I mean, we're worried about that low interest rates have created zombie companies. There's no biggie zombie enterprise in the government. They have no incentive to make a profit. They just have incentive to keep people churning over and voting for them. So that's not really the answer. What we need is the typical things that are the simple microeconomic changes in allowing a business to start up more easily, imposing less onerous regulations, imposing bankruptcies and the like when things go wrong rather than perpetuating failure. These are very simple prescriptions to elaborate, but they're very hard to get through a politician because there's no big fix, there's no button he presses or she presses that gives them headlines and a vote. But that's really what we need. We don't need macro hammering.
Talking about politicians in the States, we've got an interest rate meeting coming up there, as I said at the top, where we're expecting an interest rate cut, possibly by 25 basis points. There's apparently a lot of pressure from Donald Trump on the Federal Reserve to cut interest rates. We're told about this degree of separation between the two. One wonders just whether or not Donald Trump does actually have a hold over what Jay Powell is doing.
Well, one wonders whether he's being counterproductive, and in fact the Fed has to sit back a little bit to pretend that it is more independent. Like all central banks, there's a de jure independence, but there's no de facto independence. They are political entities given a mandate, even at some arm's length, by the political authorities of the day. This has always been the case. I mean, there are all sorts of incidents in Fed history of presidents. Johnson was famous for bullying William McChesney Martin. We've had Nixon bullying Arthur Burns. It's nothing new. I mean, these things happen. The Fed has some justification if you look at the macro numbers. The American economy slowed sharply. Last autumn, it was firing on all cylinders. It was doing the best things it had done for 5-6 years. When Trump was boasting about it then, he was probably actually right. But since then, it's slowed dramatically. And it's slowed enough that if you look at the past record of when the Fed has changed interest rates, it's certainly slowed enough for them to stop hiking. I don't think we can particularly argue with that. Now, whether Jay Powell was lucky, this happened after the event and he'd already decided that he was worried about Wall Street's collapse in the fourth quarter, or whether it was Trump bullying him from the White House. But definitely, in hindsight, the decision to pause is not out of kilter with what the Fed has done in the past in similar situations. the question now is the cut that he's almost certainly going to deliver, whether this is going to be counterproductive rather than helpful. Interest rates are so low, credit is still easy in the States for most people to come by. We have, record volumes of this, that and the other. Credit spreads are low, CLO issuance is still going, leverage loans are still being fired out, private equity has more money than it knows what to do with. Yields on our assets are going down because there's money to be spent on them. So what this 25 basis points, or heaven forbid the 50 that some people are talking about, is really going to do, I don't know. Yeah, so I would say yes, he's probably right to pause in the hiking given the deceleration to see where it goes. But given the speculative mania in markets at the moment, to add fuel to that particular flame is only going to be storing up problems of the financial stability type that were so debilitating 10 years ago and whose aftermath we're still trying to contend with.
So what are the effects of the markets then? Where does the dollar go in all this, if assuming we do get the Fed starting to cut interest rates?
Well, the dollar's one of those dogs that doesn't bark things, isn't it? It was the guy, the Fed came from this automatic hiking where we were building in 3, 4, 5 interest rate hikes, and now we're building in 3 to 4 cuts. What has the dollar done? It's had a bit of a wobble, but now it's back on it, looking strong and perky. It's strong against sterling, it's strong against the euro. Is there an underlying bid for it? Is it the classic, it's still the least dirty shirt in the laundry, which has been the cliche of the past few years? I mean, European economy's weakened remarkably, the Chinese economy's weakened, the rest of the Asian supply chain's under problems, and yes, okay, the States is, as we've said, has slowed, but it is still just growing, and maybe policy there is still just that little bit more credible, and the Fed is not seen as being a bank which will go whatever it takes, as the others are.
And so, what, buy risk on assets?
Well,
equities look still attractive. I mean, there's a lot of people saying that's where the yield is. You talk about yield, it may be shrinking a little bit, but nonetheless, there is still a yield to be had.
Well, of course, and that's why they're going bid. Everybody, there is a school of thought that says, well, they're disconnected. The, earnings have slowed. We don't know yet whether this quarter is going to be negative or just in the positive column. Earnings are slowed and the stock market goes up. This is a disconnect. But if we discount those earnings back at today's bond yields and tomorrow's bond yields and the bond yields that we think we're going to get in 6, 9 months, 12 months time, well, you can see why people are buying them. They may be taking on much more risk than they think they are, but everybody sees, for all the reasons, whether it's financial engineering, whether it's discounting, calculation, whatever, you do not want to be in the bond market. You want to use that money to buy the stock market. Now, it's building risk. I'm not endorsing it, but you can understand it.
Just a couple of things I've got to ask you outside of what we've spoken about, and that is whether or not these two elements, if they're cleared up, will it clear the air a bit? The China-US trade war, how big an issue is that for central banks at the moment, or are they not now worried too much about it? And of course the other thing is Brexit. Bit more clarity, I guess, here in the UK now. If both those two things clear up, do you see fresher and clearer air?
Well, let's do the easier of the two hard questions first. I think Brexit, there is a possibility that, assuming the Remainiac wing of the Tory party don't self-immolate and press the suicide button and destroy their own party's political prospects, that Johnson has a mandate, and he knows the goal is to beat Corbyn, and he knows the goal is to get the votes back from the Brexit party, and the only way to do that is to be firm with the Europeans, who may just be weak enough now economically as well, even though that's usually a second consideration with them, to actually do some sort of deal. But even if they don't, we all know in the background that lots of these things have been inked in, so there'll be some disruption. But if you're an entrepreneur, you've sat 3 years not knowing what that disruption is going to be. Even if it's a bad thing in October, you know what you've got to overcome, so you'll get on with it. So that could be a dip down and then a rally. I don't think it's a black hole.
Right.
China, I think China's in a lot of problems domestically. I mean, okay, China bears a perennial, they've been there for 10 years or more, but you look at this economy now, they've gone back again 6 months, 9 months after tightening. This was going to be the deleveraging, the cleaning of the stables. They've gone back to it because they're desperate. And I think if you read some of the Chinese press, however badly the translations that we non-Chinese speakers have to contend with, you get the elements that Xi Jinping's in a bit of political difficulty here as well. The States at the moment is happy to press. It's not really a trade war for them, is it? It's a strategic war, so who knows where that ends.
Yeah. Look, we've got to leave it there, but thanks indeed for joining us. Sean Corrigan there from Cantillon Consulting with a quick turn through the markets as we await that interest rate decision from the Fed on Wednesday, the 31st of July.